Hi traders, and welcome to my video on moving average envelopes. In this video I'm going to show you a simple strategy that you can use to capture moves like this one for over 700 pips and counting. So this is using the envelopes indicator, which you should already have included with your trading platform. You can simply choose the settings. We're going to use the default period of 14, simple moving average, and 0.1 deviation. Okay, let me just make the colors more prominent for you. Okay, perhaps that's too prominent, something like so. Okay, so the way that I like to use moving average envelopes is in trended markets to help time entry. Okay, it's a pretty simple strategy, this one. So this is the 1 hour euro dollar chart. Okay, you can use this strategy on any chart time frame. I just prefer the higher chart time frames as I find the signals tend to be more reliable simply because there's more price data included within the higher chart time frame. So 1 hour, 4 hour, daily, weekly, monthly. And you can use it on any trading instruments, so Forex, cryptos, commodities, stocks, indices, etc. So what we're going to do is we're going to mark our resistance up here. Okay, you can see we have an upwards trend line here. See this support, 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 but then there's a breach here of this support level, okay, which coincides with the market making lower highs. And then this support, once it's breached, you can see the price doesn't come back up again. And then we have an area of resistance here. With the lower highs, we're starting to look for sell entry into this forming. If I just zoom in, it's easier to show you into this downtrend here. So as an aggressive entry, you could have actually taken a breakout of this support level here, which in fact does go back as far as there. Okay, at least there. So in this whole scenario, we had this consolidation here. Okay, we did have a triple top formation. Okay, that's basically when the resistance is tested at least 3 times, 1, 2, 3. Then we have a breach of the support within the triple top formation here, which coincides nicely with, as I said, the market making these lower highs. Okay, you've got this wedge chart formation as well. Here, see that wedge there? I do have videos on all these various formations that you can check out. Prices within the envelopes. Okay, we'll cover that in more detail in a minute. And then we can trade the breakout of this support level. You also have a nice M chart formation there, forming the letter M, so a breakout there. You have a 3 inside down candlestick pattern there, another one there. That's when you have a bullish candle, followed by a bearish candle that's at least 50% of the bullish candle's body, followed by another bearish candle that breaks below the initial bullish candle's body. So there, 3 inside down. Okay, bullish, bearish, bearish. Okay, so lots of bearish price action, candlestick formations. Could have taken this breakout trade here. Otherwise, you could have waited for, this is where the moving average is, envelopes come into play for this particular strategy. What you do is you wait for an obvious trend. So both the deviations are heading downwards there on the moving average envelopes, or should I say the upper envelope is this one, the blue one, and the lower envelope is this one, the red one. Okay, so when price is clearly breaking out below the lower envelope, we know we're in a downtrend. What we don't do is we don't just sell anytime here. Okay, because you can end up just selling at the low if you do that. You wait for a pullback into the envelope channel. Okay, and that's when the market is said to be ranging. So we wait for this pullback here. Okay, you see downwards trend, pullback, M pattern again, and a breakout to the downside. That support then becomes resistance and a continuation of the trend. So we could have timed our entry there into the trend. We're only selling because the market is falling, so we're trading with the trend. We're just waiting for price to pull back in the channel and then trade in on a breakout. As you can see, same thing happens here. Okay, price continues to fall. We have a pullback to the channel, and you can trade on the breakout M pattern there, big breakout downwards. That is an NFP, non-farms payroll, first Friday of the month candle, but we could use that momentum to hop in on this downwards trend regardless. We do actually have some pullbacks here. You can still take those ones as well. Okay, see this pullback here, breakout, that support then becomes resistance here. Okay, same again, support, pullback, continuation, market making these lower highs. Lower high. Okay, breakout, pullback, breakout, pullback, breakout. Simple as that, really. So the envelopes we're using for helping to time the entry, we just wait for a pullback into the envelopes. I don't personally use them as an entry criteria in themselves. Some traders would trade in a downtrend, they'd wait for a breakout of the lower envelope and take that as a sell trade, which you can do as an alternative strategy. I just prefer to look at support and resistance to confirm my trade entries. Whilst, as I said, having a good eye on any candlestick patterns that may be around. I do have videos on the majority of candlestick patterns as well. They can help to confirm trades. But for me, price action, support and resistance, and trend lines, you can capture some big moves like this one. Okay, this is a 1 hour chart. No need to scalp and pull your hair out trying to day trade on the, or scalp the 1 minute or 5 minute charts all day long for a few pips here and there when you can capture moves like this. Let's just say we took the initial breakout trade. I mean, if we took it just down to this area here, potentially could have been more, but on that initial breakout, that's over 350 pips profit potential. What I would have done is my stop loss would have been above the high here. So trading that breakout, you're looking around a 15 pip stop loss, which is relatively tight for the 1 hour chart time frame. And as price fell, I'd move my stop loss to break even at the first instance. And as it continues, I'd just be moving my stop loss above the high, 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 and just locking in as much of the trade as possible. So when we do eventually get taken out, we've maximized the move as much as possible. You can close part of the position as well on the way down if you want to close a quarter, half, and just let the rest run, or just depends on your own money management preferences. What I wouldn't do is take this entry here or even here. Let's just say, for argument's sake, you took this entry, just zoom in there. You just took this entry, stop loss above the high again, 15 pips. And then you saw price fall down to here and you got excited. You've made 100 pips profit. Great, good trade, especially with a 15 pip stop loss. But you exit the position, all of it, and then price continues to drop. You've just left too much on the table. Okay, so what I like to do is cut losing trade short, like 15 to 20 pips, depending on where the high or the low is. But then when we do capture a good trade, we just maximize it as much as possible. That way we can afford a few losers here and there, or even consecutive losers, knowing that when we do eventually catch a big trend like this, we're going to maximize it as much as possible. Okay, if you miss the initial trade, you can always, trade on the pullback on the way down. Just what you don't want to do is sell too low. So if we zoom out, you don't want to, join the party down around here and sell at the low, just as you don't want to buy up here at the high. Okay, but that being said, there are some pullbacks on the way down. Remember, price pulls back into the envelopes, into the envelope range, then the market's said to be consolidating a range when it's bouncing around here. In fact, some traders would, if you're a range trader, you can actually trade within when the envelopes are relatively flat like this and price is bouncing up and around. Some traders will just buy when price goes below the lower one, sell when price goes above the upper one. For me personally, I'm only going to trade in the direction of the trends. I wouldn't be taking these long signals here. Okay. Which is another way to even enter onto the trend as well. We were entering on the breakouts of support on this downtrend, but you can also sell when price goes above the upper band. The only thing with that is it doesn't always happen. It did happen here, so this would have been a good time to sell into this downwards trend. Okay, price above the upper band. However, you can see that didn't actually happen. It came really close, but you would have missed out on a potential trading opportunity if you were waiting for the price to cross above there. But then again, it did come, pretty much close, really close to closing above the upper envelope. But and then you could have just taken the short trade based on that, looking at the price action, the bearish price action and candlestick formation as well, like the bearish spinning top here. You've got a bearish inverted hammer there. Okay. So lots of bearish signals. As I said, you could trade the range, but I wouldn't do that personally. If I had to, I would probably look for a time when the market was quiet, low volatility, and just look to scalp a few pips here and there. But I much prefer to take longer term trend trades for big profit potential. So again, breakout, breakout. You can see here the breakout's not as clear. Okay, price is still kind of within these envelopes. You want a kind of an obvious scenario like this one here. You see that? Okay. But that being said, there still are a few opportunities. You know, this nice downwards move here, lower highs. Okay, got your nice support ledge there, breakout there, or a breakout of the lower envelope. Just don't sell at the end of a move like that, for example, or even at the end of a move like that. You don't want to sell at the low. No, wait for a pullback and then look to trade on a breakout of that pullback. Okay. So ample opportunities to enter in on this trend, but again, around here, you're definitely going to be selling too low, in my opinion. You ideally want to get up in and around here somewhere. Okay. So it's just looking for an established trend. There you go. There's another one. Just mark the trend direction or follow the direction of the envelopes down, obvious in this instance, and wait for a pullback and then trade a breakout. Okay. So there, textbook trade. Big move downwards, pull back into the envelopes and a breakout to the downside. Okay. You don't have to always draw your support horizontally. You got nice M pattern and again a breakout to the downside there. Okay, same again here. For me, price doesn't always have to break below the lower envelope for there to be a trade. As I said, some would even wait for price to go above the upper to sell in a downtrend. And again, there ample opportunities to sell. Okay, even up here. Probably want to be cautious because we had this big move up, but an aggressive trader. I've been looking at this. You have this nice downwards move. Market is still making lower highs here. Done that again. Market is still making these lower highs here. Nice wedge formation, downtrend consolidation, and a breakout to the downside. Okay, so lots of good opportunities to short in a downtrend. And if we look for an uptrend here, you can see a nice a clear uptrend. So you see when the market is making these higher lows, we're in an uptrend. Okay, so how are we going to time our entry? We're going to wait for a pullback into the bands and then a breakout to the upside. Okay, so either could argue like that. Okay, W pattern there and a breakout to the upside. Slight pullback here. We'll zoom in, it'd be easier. Okay, nice move up here. Market making higher lows. Wedge pattern. Nice wedge pattern there. Okay, pullback and a breakout to the upside. Price pulls back into the channel here. Okay, breakout. No coincidence, there's a big breakout candle there. Traders are watching these levels. Same thing here. Market's making higher lows. Okay, so we want to buy. That's the first thing. We're not going to sell. We're going to buy because we're in an uptrend. We'll wait for price to pull back into the envelope channel and then a breakout of resistance because we're trading in an uptrend. Okay, and you can see there's no coincidence that you have these big breakout bars around these points because this is exactly what traders are watching. Again, resistance, textbook breakout trade here as well. But again, don't want to end up buying too high. We've already had quite a significant move up. You don't want to buy at the high, especially as you see the market start to make these lower highs here. Okay, if we would have taken this initial trade, stop loss below the low, so around 15 pips, really tight, good for the 1 hour chart time frame. Profit potential of around 200 pips. Could have used a trailing stop again. So as price shoots up, just lock in the trade at break even. Trailing stop below the low, below the low, below the low. We may have been taken out here. We could have got in on the last rally there, but still would have been a good trade. Regardless, we can always exit manually as well once you start to see this sort of consolidation in the market. Okay, and close part of the position if you wish on the way up, just to bank some pips. Okay, as I said, you can use this strategy on any trading instrument and any chart time frame. I just find that the higher chart time frames tend to be more reliable as they contain more price data. Also means less time chart watching, and when we can capture moves like these for hundreds of pips, I'm not sure why you'd want to fight with the lower term chart time frames all day long. Okay, in space of you know, a few weeks, hundreds of pips on, you know, available for trading. Here, this is a messy situation. This is one where I probably wouldn't be looking to buy or sell. In fact, this may be something that a range trader might look at. But generally, you want to wait for a clear and obvious breakout. There's just a bit too much choppiness here. And to avoid as well bad trades, you can see this. Some may argue, well, look at this. This was the start of a sell rally, but we would have waited for the pullback. So let's just say here we marked our support, pull back to the channel, but then price continued. By the time it continued up here and done all this consolidation, we could more or less cancel out that pullback and just wait for the next opportunity. So here, moved downwards, we would have drawn our support, waited for the pullback and potential breakout. It didn't happen. Price continued the other way. Okay. And looking at the overall picture, it just looks messy, no clear and obvious trend. So we got to this point and we were clearly in a downtrend. We could have started looking for sell trades. Okay. Obviously you will have losing trades. You know, there might be instances where you'd perhaps look at something. Let's have a look. Well, I can't really pick out a bad option here because it's just you wouldn't trade in it. But if you did, just say for argument's sake, you said, okay, the market's making higher lows here. I'm gonna trade, let's say, at a breakout here and a pullback, but you wouldn't trade this pullback and then breakout. You wouldn't trade because it's just too much consolidation after here. If anything, or you wouldn't do that because it's the same scenario again. You're not going to certainly buy at the high of a move like that. So yeah, you would have been kept out of trouble. You know, if you just don't, I wouldn't take a breakout if there's already been a big move like that, because you're going to just end up buying at the high. Just, I wouldn't take a, you know, I wouldn't take a trade here. I wouldn't sell at the low there. Okay, so just time your entry carefully. Have good money management, good trading discipline as well. And you can capture some big moves. You know, don't sell at the bottom of the move like this. You see a big move, you don't sell down here. You could draw a support line and wait and see if price does pull back and then break through here. Okay, and then when you do get a good trend like this, you can just simply make the most of it. You've got your bearish flag pattern there as well. Downwards move, flag, breakout. Okay, same here, downwards move, flag pattern, breakout. Okay, it's once you start to see it, it's pretty obvious to spot. Downwards move, bear flag, breakout. Okay, I've got videos on bear flags, bullish flags, various chart patterns. Okay, that can help you spot trades. These are bull flags. So you've got your flag there. Okay, you've got your flag pole, so your upwards move, your flag breakout, upwards move, flag pole, flag breakout. Okay, flag pole, flag breakout. And you can use the envelopes for breakout trading as well, or as I said, in a range traders. I wouldn't trade that. That looks a mess to me, but you know, buy on the lower envelope, sell on the upper envelope. Okay, so really it depends on your trading strategy and your preferences, but for me it's simple. I'm a trend trader, so I'm looking for a trend direction, you know, one that's obvious like this. It's an obvious uptrend. I'm just going to time my entry, and to be honest, I don't even need, if we just remove the indicator, you can use your eyes and just draw your lines. It's an uptrend, market's making higher lows. Yeah, we can see that, and then just draw your support and your resistance and trade your breakouts. Good money management, good trading discipline. You can create a strategy without needing to rely on potentially lagging or repainting indicators. Okay, please like and subscribe if you found something useful in this video. I do appreciate you watching. I hope to catch you on the next one. Take care.